Hello, good day, good day, good day. This is Abedi Kingsley again. So today I'll be talking about five major things you have to look out for before investing in any stocks. These in any stock of a company or shares. These five factors are very important that you should consider. So the first one is liquidity. What is liquidity? Liquidity simply means the frequency at which this particular shares of the company is being traded. So there are some stocks that are not very liquid. When you buy them, it's difficult to sell them. So it is good you always check liquidity. Okay, many years ago, I bought a particular penny stock, right? There was a time I wanted to sell it. For 3 months, I already placed it on sale. Nobody was buying it. So you have to consider liquidity. So another factor that should be considered, before buying stocks or shares in a company is revenue. So the revenue has to be consistent. There has to be a steady increase in revenue before you consider buying the shares of a particular company. So all these factors I'm giving you, these are not the only things you have to consider. Actually, you need to do valuation, but before you do valuation, these are just the basic things that you should consider before you buy shares in a company. So let's look at assets, for example. Uh, Look at audited financial report for 2024. So let me zoom in so that everyone can see clearly. So we are looking at a statement of comprehensive income. So look at the consolidated and separate statement of comprehensive income, page 61. So you can just enter here, 61. So here, this is it. So if you look at the previous year, there was a revenue of 1.56 trillion, right? Then in 2024, the revenue significantly increased to 3.11 trillion. So in terms of revenue, they've done well. In terms of liquidity, assets is also a very good stock. I'm just using it for example. What about profitability? So if you come here, you see that the profit has increased. In 2024 is 642 billion naira compared to 619 billion naira in 2023. So it's also a very good one. We've looked at liquidity, uh, revenue, profitability. Then let's talk about dividend. So let me also use another company that has been consistent in paying dividend. I'm not going to use GTCO this time around. Let me use Zenith Bank. Zenith Bank has also been consistent in paying dividend. So if you look at Zenith Bank, for example, sorry, it's coming up. Let me see if GTCO opens faster, then we'll use it. I wonder why this one is taking quite some time. Okay, it has opened. So let's look at their dividend history. So look at corporate disclosure. You see uh, corporate action. So this is their dividend announcement for 2024 year, right? For the year ended 31st December 2024. So they pay the final dividend of 7 naira and 3 kobo. So that is a very good one. So if you check here, you can always check there here. They also paid an interim dividend of the previous year. So they've been consistent in paying both interim and final dividend. So this is a very, very good example, to consider. Then the last factor that you have to consider before buying shares in a company is price earning ratio. So what is price earning ratio? Price earning ratio is the ratio of the price of the shares in relation to the earnings. It's as simple as that. What is the price of the shares in relation to the earnings? So if the price is lower in relation to the earnings per share, that is very, very good. But if the price is higher, it could mean that investors are paying a premium, for that particular shares of the company. Okay, so let me just give a practical example of how this price earning ratio can be derived, before I conclude this video. But please, if you've not subscribed, I encourage you to subscribe. You don't have anything to lose. Okay, so please just subscribe. Okay, consolidated and separate income statement, page 69. Let me quickly go there and check their earnings per share. So based on what is here, this is the consolidated and separate income statement now. So their earnings per share, the basic and diluted earnings per share is 35 naira 44 kobo. So we have earnings per share 35.44. Then what is the price of the shares? Let's look at it. So let's assume we are using a current price for just the sake of this video, 92.05. That's 28. So as at 29th is 92. So we just enter here 92. Price earning ratio is 2.5. It means that the the market price per share is 2.5 times higher than the earnings per share, which is a very, very good one. For some companies, the price earning ratio is usually 8 times, for some 10 times, but this one is just 2.5 times. So this is a very, very excellent example of a good price earning ratio. So I want to believe that you've understood these five major factors you have to consider before investing in the shares of any company. And please, this is not a valuation method or technique. We are going to do proper valuation subsequently, but these are just the five basic things that you have to look out for. Thank you so much for watching, and God bless you.